Hello, folks. Welcome to Kudlow. I'm Larry Kudlow. In just a moment, we're going to talk to House Judiciary Chairman Jim Jordan about his center stage big news hearing with FBI Director Christopher Wray. But first up, the other piece of big news today was a lower than expected CPI inflation report. Both top line and core inflation, ex food and energy, both of them increased at a scant 0.2% in June. Stocks rallied, bond rates fell, Wall Street liked the report. The Fed is probably still going to raise their target rate by another 0.25 point to 5.5%, though, frankly, no one is sure exactly why they're going to do it. But a quarter is kind of small beer, not worth arguing over. The 12-month change for the CPI is down to 3%. That's still a point above the Fed's 2% target. The core rate more troublesome at 4.8%, more than twice the Fed's target. So I suppose you could justify more rate hikes on that basis. Actual inflation still above the Fed's target. However, if you look at market-based price indicators, the Fed may have already done enough. Now, I'm thinking of the upside-down yield curve, where short-term rates are way above long-term rates. I'm also thinking of broad-based commodity indexes that really have been softening now for over a year, and a nod to Milton Friedman's M2 money supply, which has collapsed over the past 18 months. Now, the wonderful thing about these leading indicators of inflation is that the Fed doesn't pay any attention to them. That's too bad, because markets are really smarter than economic models. Let me take a moment for some context. In the mid-1980s, Ronald Reagan appointed three brilliant Fed governors: Wayne Angell, Manley Johnson, and Robert Heller. All good friends of mine. Mr. Heller has appeared several times on this show. They pioneered the idea of using market-based price indicators rather than the Phillips curve model that purports to trade inflation versus unemployment. Now, right now, you can bet that the Fed staff thinks it has to tighten policy more because the unemployment rate is still too low at 3.6%. In other words, too many people are working, and that must be inflationary. Now, if you think that's a stupid idea, you would be right. More people working and producing goods and services would be counter-inflationary. But back to the Reagan appointees, and I want to include former Fed Chair Alan Greenspan, also appointed by the Gipper, who testified often before Congress that gold was an important inflation indicator. Gold, by the way, has been quiescent of late. Now, this group of Fed officials basically launched 20 years of price stability by using market-based indicators. They never get credit for what became known as the Great Moderation, principally because they were Reagan appointees, and the liberal media would never credit them with their awesome achievement. And basically also, the Reagan supply-side tax cuts, along with the Fed's strong commodity-based king dollar, well, all that launched a 20-year economic boom. But again, the liberal media never gives the Gipper the kind of credit he deserves. Now, I'm not saying inflation is over yet, especially with Joe Biden's tax, spend, and regulate policies, which have stifled the economy and undermined incentives to work and invest. I mean, this top-down industrial policy, picking winners and losers with a frenzied $6 trillion spending in return for campaign contributions from woke corporate allies. I mean, this whole story is a grift, sometimes called Bidenomics. It's going to make the Fed's job of finally getting their 2% inflation target much higher. But, folks, don't despair. There's a way out of this quagmire. Remember Reagan. He cut tax rates, and he made king dollar as good as gold. And it worked for a long time.